Here is a detailed summary of Coca-Cola's KO Q1 2026 earnings call transcript, designed for clear and concise delivery. Introduction. Good morning, everyone, and thank you for joining the Coca-Cola Company's first quarter 2026 earnings results conference call. Today, we'll be hearing from Henrique Braun, our Chief Executive Officer, and John Murphy, our President and Chief Financial Officer. Please note that this call may contain forward-looking statements, so we encourage you to review our cautionary statements in the earnings release and SEC filings. We'll begin with prepared remarks, followed by your questions. CEO's opening remarks. Henrique Braun. We've had a strong start to 2026, delivering solid first quarter results despite a complex external environment. I want to thank our entire system for their continued commitment. Our focus remains on becoming more consumer-centric, embracing constructive discontent, and leveraging our digital capabilities to create enduring value. We are confident in our position to meet our updated 2026 guidance. The global operating landscape presented diverse challenges this quarter. While many consumers showed resilience, persistent inflation and macroeconomic uncertainty, particularly from geopolitical events, put pressure on others. Despite this, we are operating in an expanding industry. We delivered 3% volume growth across all segments, extending our streak of gaining overall value share for the past 20 consecutive quarters. Excluding the impact of 6 extra days and concentrate shipment timing, our organic revenue growth is on track with our full-year guidance. We also expanded our comparable operating margin, driving double-digit comparable earnings per share growth. In North America, we saw solid performance, benefiting from an easier comparison to the prior year. We gained both volume and value share. Price/mix softness was attributed to Easter timing, an unfavorable packaged water category mix, and production constraints for Topo Chico and other sparkling brands. Our portfolio's strength was broad-based, with Sprite, Coca-Cola, Fanta, Powerade, Smartwater, and Minute Maid all growing volume. Trademark Coca-Cola notably led industry retail sales growth. Innovation, such as Coca-Cola Cherry Float and Powerade, significantly contributed to revenue. Latin America saw value share gains and growth in volume, revenue, and profit by focusing on fewer, more impactful initiatives. Volume growth in Brazil and Central America offset declines in Mexico and Argentina. We're balancing relevance and scale, integrating marketing and commercial plans, and leveraging connected packaging for consumer insights during events like the FIFA World Cup. In EMEA, we gained value share and grew volume across all operating units, along with revenue and profit growth. In Europe, despite a cautious consumer environment, we improved share by linking brands to key occasions and focusing on value offerings. In Eurasia and the Middle East, we gained share, but March volume declined following the conflict's onset. Our priority remains the safety of our associates and partnering with customers. In Africa, we highlighted the local nature of our system and sharpened revenue management. Asia Pacific grew volume across all units, despite cycling a strong prior year. Revenue grew, but profit declined due to commodity pressures, headwinds in tea and coffee, and inventory cost phasing. In ASEAN and South Pacific, impactful marketing and innovations, like Fanta Pineapple, drove growth. In China, we stepped up execution during Chinese New Year, and in India, we focused on affordability and linking brands to consumer passion points like the T20 Cricket World Cup, expanding rural distribution. Japan saw value share gains by focusing on consumer needs and refining pack options. Our strategy is centered on the 4 I's: insight, inside, innovation, and intimacy, coupled with integrated execution. This approach, leveraging data and digital capabilities, allows for greater precision in serving consumers and customers. 4. Instance, the relaunch of Coca-Cola 00 in Europe, catering to consumers monitoring caffeine intake, has seen strong trial and repeat rates. Sprite's global It's Dead Fresh campaign and localized product launches, like Sprite Prebiotic in China, are driving strong volume growth. Fuse Tea, with its Made of Fusion campaign and localized portfolio, achieved double-digit volume growth. Commercial excellence is critical. Our system added over 600,000 outlets in the past year, increased visible inventory share, and installed over 340,000 cold drink units to drive transactions. We continue to be leaders in customer value creation. Overall, the focus on the 4 I's has resulted in volume and value share gains, and more weekly plus drinkers. To summarize, while the external environment remains dynamic, we are anchored by 3 core beliefs: the resilience of our industry, the power of our brands, and the advantage of our pervasive yet local system. We will continue to invest in these beliefs with our all-weather strategy to achieve our objectives. CFO's remarks. John Murphy. Thank you, Henrique, and good morning, everyone. We navigated market dynamics effectively to deliver on our global objectives. Financial highlights for Q1 2026. Organic revenue growth increased by 10%. Unit case growth grew by 3%. Concentrate sales were 5 percentage points ahead of unit case sales, reflecting the impact of 6 extra days offset by concentrate shipment timing. Price/mix growth was 2%, primarily driven by approximately 4% in pricing actions, partially offset by 2% unfavorable mix. This mix was due to Easter timing and category mix in North America, stronger growth of value offerings in Asia Pacific, and geographic mix in Latin America. Comparable gross margin declined by approximately 30 basis points, mainly due to commodity pressures in tea and coffee, inventory cost phasing, and trade spend timing. Comparable operating margin increased by approximately 70 basis points, driven by operating expense efficiencies and continued brand investment. Comparable earnings per share, EPS at 86 cents, increased 18% year-over-year, including a 3% currency tailwind. Free cash flow was approximately $1.8 billion, an increase versus the prior year. Balance sheet remained strong with a net debt leverage of 1.6x EBITDA, below our target range. We are judiciously managing the balance sheet while awaiting a court decision related to our IRS dispute. 2026 guidance. Enabled by our all-weather strategy, we are on track to deliver on our updated 2026 guidance. Organic revenue growth. We continue to expect 4% to 5%. Comparable currency-neutral EPS growth, excluding acquisitions/divestitures, we now expect 6% to 7%. Commodity volatility. While certain commodities, like tea and coffee, show volatility, the overall impact on our cost basket is currently manageable. However, geopolitical tensions introduce uncertainty. Divestitures. Expected to be an approximate 4-point headwind to comparable net revenues and a 1-point headwind to comparable EPS. This assumes the pending sale of Coca-Cola Beverages Africa closes in the second half of 2026. Currency. We now anticipate an approximate 1 to 2-point currency tailwind to comparable net revenues, up from 1 point previously, and an approximate 3-point currency tailwind to comparable EPS for the full year. Effective tax rate expected to be 19.9%, a 1-point reduction from our previous estimate. Overall comparable EPS growth. We now expect 8% to 9% growth versus $3 in 2025, an increase from our prior estimate of 7% to 8%, driven by the lower effective tax rate. Key considerations for 2026. The fourth quarter will have 6 fewer days compared to Q4 2025 due to a calendar shift. Easter shift into Q1 provided a 0.5-point benefit to first quarter volume. We expect concentrate shipments to like unit cases to be a couple of points apart in the second quarter. Assuming the CCDA sale closes in the second half of 2026, we anticipate margin expansion opportunities in the latter half of the year. In summary, we remain focused on executing our strategy and are well-positioned despite macro complexity. Our goal is to drive balanced top-line growth, margin expansion, cash generation, and long-term returns in strong partnership with our global bottlers. Key financial metrics summary: Q1 2026 revenue. Organic revenue grew 10%. Q1 2026 profit. Comparable EPS increased 18% year-over-year to 86 cents. Free cash flow was approximately $1.8 billion. Q1 2026 gross margin. Comparable gross margin declined by approximately 30 basis points. Q1 2026 operating margin. Comparable operating margin increased by approximately 70 basis points. Management's forecast for future quarters and full year 2026. Full year 2026 organic revenue growth expected to be 4% to 5%. Full year 2026 comparable currency neutral EPS growth, excluding acquisitions/divestitures, expected to be 6% to 7%. Full year 2026 overall comparable EPS growth expected to be 8% to 9% versus $3 in 2025, an increase from prior estimates. Full year 2026 currency tailwinds anticipated at 1% to 2% for net revenues and 3% for EPS. Q2 2026 expect concentrate shipments to lag unit cases by a couple of points. Second half 2026, potential for margin expansion if Coca-Cola Beverages Africa sale closes. Significant risk factors: macroeconomic uncertainty, persistent inflation, and global macroeconomic volatility driven by geopolitical events like the conflict in the Middle East continue to pressure consumers. Commodity pressures: volatility in certain commodities, particularly tea and coffee, poses a challenge, though currently deemed manageable. Geopolitical tensions: uncertainty stemming from geopolitical tensions could impact the company's outlook. IRS dispute: the company is awaiting a court decision related to an ongoing dispute with the IRS, which influences balance sheet management. Divestitures: pending divestitures, such as Coca-Cola Beverages Africa, introduce headwinds to net revenues and EPS. Currency fluctuations: while currently a tailwind, currency movements can impact financial results. Highlights: strong Q1 performance, delivered solid results despite a complex external environment. Volume growth: achieved 3% volume growth across all segments. Value share gains: extended streak of gaining overall value share to 20 consecutive quarters. EPS growth: double-digit comparable EPS growth. Consumer-centricity: strong execution of the 4 I's strategy: insight, inside, innovation, intimacy, driving consumer connection. Brand strength: notable performance from trademark Coca-Cola, Sprite, and Fuse Tea. Digital capabilities: effective leverage of digital tools for precision and consumer engagement. Commercial excellence: expansion of outlet coverage and improved point-of-purchase presence. System partnership: strong collaboration and trust with global bottlers. Updated guidance: increased full-year comparable EPS growth forecast. Lowlights: gross margin decline. Comparable gross margin declined by approximately 30 basis points, primarily due to commodity pressures and inventory cost phasing. APAC profit decline. Profit in Asia Pacific decline driven by commodities, headwinds in tea and coffee, and inventory cost phasing despite volume growth. Mexico volume decline. Experienced volume declines in Mexico, though offset by growth in Brazil and Central America. March volume impact in Eurasia/Middle East. volume declined in March after the onset of the conflict in the region. North America price/mix softness, attributed to Easter timing, unfavorable category mix in packaged water, and production capacity constraints for some sparkling brands. Most important statements from CEO and CFO. From CEO, Henrique Braun. We are off to a good start this year. We delivered strong first quarter results despite a complex external environment, emphasizing a positive start and resilience. We are focusing on becoming more consumer-centric, remaining constructively discontent, and leveraging our digital capabilities to create enduring value. I'm confident we are well positioned to deliver on our updated 2026 guidance, outlining strategic priorities and confidence in future performance. We harness the power of our brands and our unmatched system reach to deliver 3% volume growth, and we grew volume across all segments. We also extended our streak of gaining overall value share for the past 20 consecutive quarters, highlighting key operational achievements and consistent market share gains. Our strategy is centered on the 4 I's: insight, inside, innovation, and intimacy, coupled with integrated execution. This approach, leveraging data and digital capabilities, allows for greater precision in serving consumers and customers, defining the core strategic framework driving execution. To summarize, it's early in the year, and we know the external environment remains complex and it's quickly evolving. However, we continue to benefit from 3 unwavering beliefs. 1. We are in a great, resilient industry. 2. We have a powerful portfolio as demonstrated by our $32 billion brand. 3. Our pervasive yet local system is a clear advantage, reiterating foundational strengths and long-term confidence. From CFO John Murphy. We navigated market dynamics locally to deliver on our global objectives. We grew organic revenues 10%, confirming strong top-line performance and effective execution. Comparable gross margin declined approximately 30 basis points. However, comparable operating margin increased approximately 70 basis points, as we've realized operating expense efficiencies, while investing further behind our brands. Clarifying the interplay between gross and operating margins, highlighting efficiency gains. Putting it all together, first quarter comparable EPS of 86 cents increased 18% year-over-year, helped by 3% currency tailwinds, providing the key bottom line result and its drivers. Enabled by our all-weather strategy, we're on track to deliver on our updated 2026 guidance. We continue to expect organic revenue growth of 4% to 5%. We now expect growth in comparable currency-neutral earnings per share of 6% to 7%. Presenting updated financial targets with confidence. All in, we now expect comparable earnings per share growth of 8% to 9% versus $3 in 2025, which is an increase from our prior estimate of 7% to 8% due to the lower effective tax rate, signaling an upward revision to profit expectations for the year. This concludes the detailed summary of Coca-Cola's Q1 2026 earnings call.